What does that bet say to you? What do you think that trader is trying to accomplish besides, making money?
Yeah, we watch that with great interest because it's also signaling to us kind of a really interesting shift in sentiment, Brian. Options market sentiment up until recently has been very glum. It's really been more demand for hedges, and that, those call spreads that you mentioned were pretty substantial, but, they weren't the only ones trading in the market. I think their size kind of made them notable to several people. And then obviously there are hedging dynamics around those call spreads being so large that actually helped push up the market as well intraday. But those trades are ones we are actually seeing more and more investors doing. They're monetizing those downside hedges, and they're actually reversing. They're buying calls, they're buying call spreads. They're essentially expressing much more bullish sentiment that we've seen in a while.
Wow. And what's so important, Amy, in what you just said was we have talked a lot in this last, couple years on this program in particular about market structure and the impact that options and derivative strategies, Delta One, all these sort of things you talk about, but most of Americans have no idea what they are, how much they matter. Your point was a trade like that, while 50 million is kind of, I know peanuts in the big world of hedge funds, the fact you said that it actually did shift parts of the overall market. How do they correlate?
Yeah, it's a dynamic we've seen more and more. You and I have talked about on this show about retail call buying and how when that happens in mass too, that drives up the market. To give you a very straightforward example, if you buy a call option, there's somebody else who is selling you that call option. That person is usually a dealer, a broker dealer, someone who doesn't really want to have a directional view. They're just trying to facilitate this trade being done. So something they do, which is called a delta hedge, to help them neutralize the stock position, is if they sell a call, they'll try to buy more shares to neutralize the delta of the option or the sensitivity of the option to underlying stock moves. When that happens, that can exacerbate up moves. So you've seen that. I don't know if you remember the NASDAQ whale back in August, I think, of 2020. Very exacerbating situation for a lot of stocks like Facebook, like Apple, I believe, and also Salesforce, which I think had a one-day move of 26% on earnings. Those are all related to dealer delta dynamic hedging in the market.
I think delta is the word I've been using more the last 2 years, except for maybe one other word, as I sort of try to understand your world, and that is skew. It's the word of the day. Because when you look at the skew, which is sort of the extreme call buying from individual options traders, what you're seeing now, and correct me if I'm wrong, Amy, means that people, not just whoever this trader is, are getting more bullish into year end.
Yeah, and what's notable about that is when we had drawdowns in kind of the past couple drawdowns we've seen, people had actually been getting more bearish. So as the market went down, people actually bought more hedges. And so one thing I had said was, look, you're going into a market that's very well hedged. A market that's very well hedged has trouble going down. And the reason is people aren't going to be panicked when they see that drawdown because they do have that hedge in place. Now we've started to see these hedges being lifted. We're starting to see people buy more upside. And so the opposite is actually true, Brian, which is you're going into a market that is starting to decrease its hedges. So if we do see a drawdown now, there's less hedges in place, and there may be that scramble to place those hedges later on, which could cause kind of an interesting volatile environment in the future.